Welcome back to Dadvestor. I just wanted to go over my new platform. I still have Robinhood, but it's just an inferior platform, and for what I'm doing for strategic investing, it's not. Maybe I don't even know if it might be worse. I don't know if it's better in terms of classic investing. If you're just trying to buy stocks, like or whatever, ETFs. If you just want to invest in SPY, you could use anything. Basically, everything is really good at that. So it's not really made for that. It's built for looking at metrics like IVR, tracking your days to expiration, your probability of profit, your theta, your delta, all that stuff, days in the open, like all of this stuff. So let me show you real quick. So this is an awesome thing for me too, because they kind of block all my account numbers just so I can share this. So anyway, I started with $2,000. I think it was 2 weeks ago. It might be less, but it's give or take 2 weeks ago. Give or take a few days or a few weeks. Less than a month. So what is it? June, July. It's July. So I started this in July at some point. Put $2,000 in, and immediately, oh, you know what? Basically, the day that I got approved for my transfer was when I made these two positions, which they look terrible, right? Like right now, the market is down, but these are two Strangles, one on the micro NASDAQ and one on the micro S&P futures. If you don't know about futures, that's a whole other thing. We're probably going to go into it, but futures essentially contract-based instruments, and they're based on something. So these are based on the NASDAQ, which is top 100 companies, and it's weighted for tech companies and other top performers, and then the S&P 500, and these are contracts based on these for the future. So you could buy a contract at whatever price. So looking at this, let's say we bought a contract at 5,562 for the S&P, and that contract is going to be true in the futures. So futures contracts, I guess I'm going to go to explain futures, but futures are basically contracts you can buy, and then they have an expiration, at which point you can spend the money on whatever it is you're buying. So if it's corn, you can buy a futures contract for corn, and that's what it was based on. Originally, it was for like farmers and stuff like that, and companies who want to buy stuff. It's like, okay, well, I'll make a contract with a farmer for 100 things of corn, whatever it is, bales of corn or whatever, bales of wheat, whatever of corn, and that way I can lock in a price, and then next year I'm guaranteed to have that corn for my restaurant, let's say. But then they started using the same idea with the Chicago exchange for the S&P 500 and then the NASDAQ, or triple Qs. So you can see these are based on like what I'm already using on my Robinhood account, which is the SPY and the QQQ, and these are contracts based on that. So if you think of like the SPY, it's like, each share is $500, give or take at this point. I think it's like $550, give or take. They all track, but anyway, so using futures, you can, if you run, so futures by themselves, you can day trade them and all that. But you can also do what I'm doing, which is you can run options, strategic investments on them. And that's sort of what this is. This is a strategic investment. It's a strangle on the S&P 500 futures, and it was for, I don't know, what's 16 plus 64, so 70, it's like 80 days, give or take. So an 80-day strangle, and if you don't know what a strangle is, it's an Iron Condor that basically has no, it's just selling a put, selling a call. And so it's, unfortunately on this platform, I can't show you like a picture. It doesn't have a good picture in terms of that, but let me see if I could show you an example. So a strangle, so specifically a short strangle, so that the price, to make money, the price stays within our two strikes. Let's see, so maybe you don't see. This doesn't work so great. Not my favorite visual on the app. I think on the Desktop, it's fine. It looks, you can see everything, but like it's so, my phone maybe is too small, but you can't really see. So what I do is I just use the chain here, and I don't know why it's so weird, but let's clear everything. So let's say we went out, this is Tom King style, so where he goes like 90 days, give or take, 80 to 100 days, and you can see the deltas. So what he likes to do is oops, let's cancel everything. What he likes to do is skew it up. So you go a little higher on the bottom side. So this is the bottom side, see on the right. And that if you look at the top here, it says puts. So this is the put side on the right. And if I convert this into a stop, so that's a sell, so that I sell, you can see on the left side that there's like a red bar down here, and then on as you go up, it's green. That means if the price is above this point, then I make money. And right now it's only $52. And the reason why is because this is the micro. If it was a macro, it would be $5.25. Okay, so you sell the put side, 7 delta, give or take, and considering whatever, like the price, you can choose depending on your risk tolerance. If you know anything about delta, if it's a 0.07, that is a 7% chance that I'll lose because I've taken the opposite, right? So if you were just buying this option, I switch it to buy, then the probability is based on that. So it's like buying this option, see how it flips. Now the green is going down. That means if the price goes down, then I win. And so you have a 7% chance of winning. When you take the opposite side, then it flips it. So I have a 93% chance of winning this, which is why it's not a ton of money, right? $52 in 82 days. So what's the point of this? Well, the point of this is you can take both sides, and go all the way up and skew it a little bit up. And so in this case, you could skew it here to the 6 delta. And see now, if you look on the right at that green number, max profit, 145. And the buying power efficiency is, or the buying power effect is negative 451. So you only need 451 to place this trade, and then you can let it go through. The reason why these numbers are so low is because I don't have that much money, so I can't easily make one of these positions on a bigger instrument. Like if we do this in the ES, it would be a lot more. Bear with me, and I guarantee this won't take as long as it just did because I was explaining things. But let's say we went on the real one. On the real one, we go to that same 82 days to expiration. We go to that. We're skewing it down. We're skewing it up. So let's say we went here and we went all the way up here and skew it up so that it's a little bit up. So you can see it's in the thousands now. So instead of 145, it's 1,437. So that's awesome if you have that much money, and this is not a big position for you, but this is too big for me. So I went with the micros, which are 10 times smaller, or a little, maybe even smaller than that. I don't know exactly why, but the buying power reduction was much less than this, right? So I got a really good deal. And that's the whole point of selling options on futures, is you can get a really good deal out of it. And you can kind of switch it up where you don't have access to this on Robinhood, but you can switch it up to where you're on the micros like I just showed you. So that's what this position is. When I open it, I don't know, it's 100 something total, and this one as well. But because the market dropped so far, so if you look at, let's stay with S&P. My two strikes are 50.25 and 64.50. Right, so it's more than, well, it's a couple hundred. Is that 1,000? I can't do math right now, but you can see it's hundreds, if not over 1,000. But I think it's not. So it's just like 64. No, it is. It's 14, almost 1,400. So almost 1,400. So 1,300 and whatever. So, but that's the space between the two strikes. And so the price can fluctuate hundreds of dollars in it. Not that it doesn't matter, but I'll still make money in the end. But the strategy is built actually for, so days open, 16 days. The strategy is meant to be cashed out around the 21 days in trade. But because the market dropped so much, that's probably not going to be profitable. It's still negative 57. And then the NASDAQ is even worse because it dropped even more. So I'm still safe, so I'm going to hold on to these, but they're not doing what they're supposed to do. But it's strange times. But what I really am doing, and this is sort of what people have been asking me about, is SPX. And so running options on SPX, which is a better index than SPY, we can do that here. And I've been doing the 0 days to expiration, and I place it at 2 o'clock. And so this is how I do it. This is how I do orders. If you just look at it in terms of delta, you kind of have to look at it that way. And the standard deviations help because the standard deviations are also part of that, where one standard deviation is like an 84%, and then two standard deviations is like 95% probability. And so I just like to use the delta because they don't always match, but the delta is based on the pricing, which is based on the price movement and the volatility. So in my experience, it is the best metric that we can use. So just like everything, if you get closer to the money and you have a smaller Iron Condor, then it has more risk, right? Because the price can only move between these two, and it could easily shoot up and hit one of your strikes, and then you lose money. But for the zero DTE, it's Sunday, so there's no zero DTEs until tomorrow. But what I've found is that after 2 o'clock, the price doesn't move that much. Even then, if you're more risk averse like me, you could have wider strikes. But you can see this is a huge, like $200. You only put in $295, and worst case scenario, you lose $295. But you do this, and you're right. Even 51% of the time, you'll be. I think you'll be in profit. Actually, I guess I haven't really thought about it, but I have closed positions early just to make sure I don't lose. So I haven't actually lost with this strategy in the past week, maybe week and a half that I've been doing it. So this is my huge money maker. This is why, even though my things are negative, my cash is 2,513, because this strategy has basically been making money the whole time, in spite of my two Strangles being a problem. The Strangles hopefully will become positive, in the next 10 days or less, as the price grinds back up. But I'm just going to leave them, and hopefully I'll take them off sooner than later, and I'll continue my SPX strategy. So that's what I'm doing right now. And I might end up transferring my accounts into Tastytrade because, as I just showed you, I like that platform better. It just, you can do more things on more instruments, and it has been pretty good and fun. So, all right, keep it real, y'all.